Now, in this session, we are going to discuss about a financial statements model. So, financial statements are the main statements in financial model. So, the financial statements consist of three reports: the income statement, cash flow statement, and the balance sheet. Now, please find time to continue read this Word document up to the end. Now, if we scroll down towards the end of this document, in this case study, we'll be opening a small cafe and applying for a business loan. So the bank asked you to create a three-way financial model for forecasting the business income, balance sheet, and cash flow. So that is what we are going to, the demonstration that I'm going to perform will be based on this. So assume that we are opening a small cafe and we are applying for a business loan, and we are building a model, a three financial model for that business. So the model is under session 9. You can download that, and this is the model that we have. So we have the balance sheet, we have the assumptions, and then the revenue and the expense and the cash flow for the small business that we are going to operate. But first of all, we have to build these three models for the financial statements for the bank. So I want you to go to the assumption sheet. We will start from the not the assumption sheet but the balance sheet. Go to balance sheet. Now, first thing that we have to identify is our expense when we want to start off this business. Now, first thing, this coffee business, this cafe, we will need a coffee machine. So the coffee machine expense will be 7,000. So let's say it will be 7,000. So let's type 7,000 here. 7,000, and then the furniture will be 32,000. Working inventory 3,000, and then working cash that we need will be 8,000. Okay, so it's 8,000, 3,000, 7,000, and 32,000. So that will be the funds that we will need. We will use the amount of money that we will use for those particular items. We use auto sum. We can use sum function to sum these cells, and it gives us 50,000. So use of funds will be 50,000. Assume that we have the equity raised is 25,000, and the amount of money that we are going to borrow from the bank is 25,000. So make sure the source of funds and the use of funds must be equal. Both of them must be equal. So we have 50,000 here, and we have 50,000 for the that will be used for the fund. Use of funds will be 50,000. Now the source of funds will be 50,000 as well. So they have to balance out. They should be equal. The next thing, now we have already entered these values in the balance sheet. Now I want you to go to the assumption. So we are going to assume, we are going to make assumptions. So let's say if we are going to sell the cups of number of cups of coffee per day, then we assume that there will be 150 cups per day, 150 cups per day that we are going to sell. And the large cup, 50% large cup, let's say 50% large cup and 50% small one. The price for the large cup will be 20. Let's make it 450, and small cup will be 320. So that's the revenue that we are going to make per day. Is that the number of cups we are going to sell is 150, and 50% will be the large cup, 50% will be the small cup, 450 for the large cup, and 320 is for the small cup. Now let's assume the expense. So for sure we know that we'll spend money to buy the cups. So let's say it will be 0.5 for a cup per cup, and then the salary that we are going to pay, and other staff cost and benefits as well. So these two values we have to identify as well. We have to assume what value. So let's refer to the data that is already in place. So we are all using the same, we are all entering the same data. So yes, so the barista salary, it will be 30,000, and then the other staff's cost and benefits 20%, and then we have the monthly rent will be 1,200, and the monthly utilities such as electricity will be 200, and the interest rate from the bank is 7%, and the income tax is 25%. So these are our assumption based on the expense, our expense. Now let's move on to the other assumptions part of it. So other assumptions part of it, let's say in each month, number of business days per month, we have to identify the number of business days. So let's say in the month of January, it will be 21. Okay, 21 days. We will work only 21 days, and then it continues on. So 20, 22, 22 again, 22, 30, 31, 31, then October, September will be 30, and we have 31, 22, October, and November 22, December 18 working days. So these are the it's just the number of days, number of business days in a month. And then the seasonality variance Okay, the percentage of an annual average based on historical demand for the data. So we will just have to type this percentage down. So it's basically the seasonality variance. So we have 80%, 80%, 90%, 100%, 110, 120. Okay, so that's it. That's the first part of it, is to make so our assumptions. We have already identified the assumption part and the revenue assumptions and the expense assumptions that we are pretty sure the this will be our expense assumption and the revenue assumptions. Now the other assumptions, we are just assuming that the number of business days per month will be this, and then the seasonality variance will be this. Now take note that these are just assumptions. These are just assumptions, and this is our balance sheet based on the funds that we will need and the funds that we are going to use. So I'll see you in the next video for the revenue part of it.